Well, natural gas futures finally cracked below the 200-day MA on Monday after weekend weather data shifted warmer for the opening days of December, with a stubborn warm ridge expected to hang on over the eastern U.S. and keep true Arctic air bottled up over the northern Rockies and plains. As I cautioned repeatedly in last week's reports, this was the main vulnerability in the entire cold December narrative, yet speculative traders pushed prices sharply higher anyway, ignoring how fragile that setup really was. That warmer shift is now emboldening sellers to drive prices through major support, while the bulls are hesitating, clinging to the hope that tomorrow's model runs will magically revive colder risks for early December. Cold is still expected to show up eventually, but the timeline keeps slipping, and the market's inflated pricing seems to be built on wishful thinking rather than firm meteorological signals. Monday's pullback, which nearly yanked the front month out of technically overbought territory for the first time in almost 2 weeks, happened despite record LNG feed gas flows. Daily intake hit an unprecedented 18.6 billion cubic feet per day on November 15 as Venture Global's Plaquemines plant alone drew a massive 4.1 billion cubic feet per day. Yet even with all that demand, the underlying fundamentals tell a different story. Lower 48 production has climbed to 109.3 billion cubic feet per day so far in November, up from 107.3 billion cubic feet per day just a month earlier. In short, last week's surge was driven by a mix of early-season cold, record LNG export demand, and a sizable dose of raw speculation. But when you strip away the hype, the pricing simply doesn't square with the fundamentals. According to the fair price model, natural gas remains deeply overvalued, with winter contracts from December through February trading at more than 40% above fair value. To justify the current price levels, U.S. storage would need to be sitting near a 100 billion cubic feet deficit versus the 5-year average, not the modest surplus we actually have. For now, the market is priced for a winter that hasn't arrived, and may not arrive soon enough to support these elevated levels. From a technical perspective, the short-term tilt has shifted modestly bearish. With the weather models pivoting warmer and the 200-day MA now acting more like resistance than support, the market looks primed for a period of profit-taking. At this point, there's roughly a 60 to 65% probability that prices continue to ease lower in the near term, while only a 40% chance that bulls regain immediate control without a meaningful pullback. Another burst of cold still appears on the horizon for early December, but that catalyst is more likely to matter after the market cools down from its recent highs. A more attractive long-side setup may emerge once prices retreat into a healthier range. For now, most traders are watching $4.20 and $4 as the key zones for dip buying interest to reappear. Please don't forget to check out the ads and leave a comment to support the channel. See you next time.